of Financially in Sync at Raymond James in Waterloo, Ontario, Canada. Today on the webinar, where do we investors stand? It is Friday, March the 27th, 2026. Let's get started. We will sort off by week. You can see another risk-off week for sure. Gold, silver down on the bottom of the list, and again, lots of short and intermediate term red there, lots. And then again, we've got long-term trends still mostly intact, but again, really across the board, if you look at red, what we've got is bonds have just been absolutely ugly as yields have continued to rise amidst the recent conflict. We will get to all that and more. A reminder to pause your video player at any time for more details. Now, I think March 9th right now stands out as interesting. That was last Monday. You can see crude oil peaked, went to $120 a barrel, closed yesterday around 95 bucks or so. Volatility also peaked last week, which is interesting because stocks, as you can see in the lower panel, certainly as measured by the S&P 500, have continued to go lower. They didn't quite make a new low yesterday by the looks of it, but the bottom line is they did definitely not bottom at the same time as volatility and crude oil at this moment have peaked. Yields also did not bottom at that point, or I should say they didn't top. They have continued to climb higher. You can see here the 10-year yield in the US has gone from below 4% to over 4.4% this month, which is pretty significant. Now, interestingly enough, yesterday, you can see here in the bottom panel, we've actually got more highs than lows. So this is the Russell 1000, about 3.2% of stocks made highs, 2.2 made the lows. And so again, you know, to see protracted weakness, what we need to see, or what we would have to see, is more lows than highs. And so that's interesting that even though the market has continued to appear quite weak on the surface, I think underneath it's not as weak as it may appear. It's interesting. Again, here's the volatility VIX chart that I like to show. You can see the US market clearly, you know, has been down, it's oversold, but volatility, again, since that last buy signal earlier this month, has not fired because we're sitting here in lower high territory. I do want to point out here that there's been a reversal here. So this is stocks versus commodities. This is the S&P 500 versus commodities. You can see here on this daily chart going back over the course of the last 7 or 8 years, this is now a lower low. And again, bigger picture, you can see this area in 2024, 25, 26 is without question a fair bit lower than it was back in 2020. Translation, stocks versus commodities are in a downtrend, bigger picture, which means commodities are outperforming. So when we think commodities, what do we think? We think rising interest rates, we think rising inflation, we think falling bonds. Again, that seems to be what's happening. Now, again, this is not quite a weekly finished chart here. This is that DC ATR long model I like to use here from an S&P 500 standpoint. But again, at this point, the model is turning upwards, which means I'll put a vertical line on there as I've done. You can see past vertical lines have actually been pretty good at, you know, looking forward to weakness. And so again, there's certainly a few flags on the field, despite some of the other positive factors that I already pointed out. You can see the Mag 7 stocks. These are the biggest stocks, you know, the Facebooks, the Googles, Metas, Amazons. These have been very, very weak, making lows for the move yesterday. So that's an absolute downtrend, and they continue to be in a relative downtrend, not only falling in themselves, but falling relative to the market. So that means doing worse. Multiple time frames here. I do want to look again, just kind of peek in on Toronto versus US. So this is Canada versus US stocks. Very, very clearly on the right side of your screen here, this is an uptrend over the last year and a half. You can see on the bigger picture over the course of decades. Still, again, lots of work to do. I think there's lots of pent-up potential from this going forward in terms of years ahead. That being said, as we flip onto the next chart, we're reminded that gold versus Toronto has also been in an uptrend, which means we sat here and I just showed you Toronto stocks versus US stocks, certainly going upwards in the last year and a half. That's interesting from a relative strength standpoint. But now here we are saying in the last several years, gold clearly outperforming Toronto stocks itself, as is the case with gold outperforming US stocks. So gold has actually been a better asset. All that to be said, it appears that gold peaked this month. Now that is to me very interesting. We have at this point, again, March isn't quite finished, but this will be the biggest bar against, which is again really a way that I like to look at the magnitude of movement, right? So in terms of going from up a high level to a low level and seeing basically sellers come in and basically take things going lower, engulfing all the activity of the course of the past month and a half. And so at this point, I'll call this the biggest bar against. Now I'm not a Fibonacci kind of, you know, expert or aficionado, excuse me, but at the same time, you look at this middle range here. So anywhere from around 2,700 to 3,700 on a US dollar gold price would be called the kind of box, right? Which would be on a correction basis, would be kind of coming into that box. I've just showed you into the, you know, halfway down there. That'd be about another 26% down. Again, that would be in the context of a long-term uptrend. So do understand that when I say gold has appeared to peak, it means that there's a peak. It doesn't mean that there's an all-time peak. It does not mean that gold will not be going higher over time. time, but I do think it needs to now prove itself, and it's going to take some wear and tear, and it's going to take some back and forth backing and filling, if you will. So remember, Canadian stocks better than US stocks, gold better than Toronto, but gold peaked. So what does it all mean? Well, it means we got to be a little careful here. What do I think's next? Well, actually, I think what's next is that these energy stocks, which have been nothing but straight upwards, again, showing the XEG, that's the Canadian energy stocks on the left-hand screen. I think it would be surprising at all to see these stocks peak out and certainly come back in and have an everything else rally take place. You can see on the right side of your screen over the last month, Bitcoin being the strongest out of what I'm showing here, but again, bonds down, stocks down, Mag 7, emerging markets, gold, silver. Wouldn't surprise me at all if we end up sort of seeing a situation where everything rallies except for the energy stocks. So just remember that energy's come a long way. These stocks are certainly going to be subject to any type of news flow that could come out of the Middle East. And from all that perspective, let's finish off with Sector Watch. There's the energy stocks at the top of the list. You can see, again, just like the broad intermarket standpoint on the first slide, lots of short and intermediate term weakness and everything in between. Next week, I'm speaking in Guelph, talking about leverage actually on April the 2nd. The week after, I'll be appearing on CNBC Arabia on April the 8th. And please follow me on X. I'm at David Cox RJ. Thanks again for your time this week. This has been David Cox, Portfolio Manager at Financially in Sync in Waterloo, Canada.